Hey guys, hope you are all having a great Saturday full of fun. As usual, I am making a small video today centered around one single topic, and that is the way retail traders will be blamed for breaking the economy. I will briefly go over how Wall Street is using a new type of collateralized debt obligation, which were the leading cause for what happened back in 2008, to maximize on profits short term and how it has slowly made the bed for the next economic crash. Though I typically like to make chill videos on weekends, I feel I have to break away from this today, because it is super important that you guys know how Wall Street adapted an old strategy and how they are keen on using retail investors as scapegoats to escape culpability and save face in the eyes of the rest of the world. I am going to make this video very short and to the point, and you do not need to have any sort of pre-existing knowledge about 2008 to understand what I am about to break down. I want to thank Jack Tasman for some of his work in putting together research, as well as Nick Rugia for really shaking into me the huge role shadow banking has on the current ongoing situation with the squeeze. Before we get started with today's segment, let me quickly disclose and state that I am not a financial analyst or advisor, and that all contents discussed in this video are provided as opinions. All efforts are placed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Everything presented is evidence I collect, and all opinions are based on research, experience and knowledge on the matter. Shout out to all my Patreons and one-time donors, who continue to support and carry this channel into greatness. I want to start by having a quick look into collateralized debt obligations and its role in the Great Recession that took place starting in year 2008. A collateralized debt obligation is a financial instrument that pays investors from a pool of revenue-generating sources. One way to think of a CDO is by thinking of it as a box in which monthly payments are made from a variety of sources. Collateralized debt obligations come in different risk levels, which are mostly divided into three segments. CDOs are risky investments, because their value is derived by underlying commodities, mainly mortgages. So, prior to the collapse we saw in 2008, CDOs proliferated through shadow banking. I made a huge video on shadow banking, which I will leave in the description if you want to know what it really is in more detail. Shadow banks facilitate the creating of credit across the global financial system without regulatory oversight. They have invested a system that allows them to manipulate credit to their advantage with little to no consequence for them as the expense of creating market crashes every couple of years. When I say the system is built to capitalize profits and socialize losses, I am not trying to sound cute and appealing. It is the factual nature of our current economic system. Go watch the video if you want a more in-depth overview. Now, the shadow banking system also refers to unregulated activities by regulated institutions. A great example of this comes from credit default swaps, which we have talked a lot during the past couple of weeks. Hedge funds are regulated institutions per se, but they are allowed to perform unregulated activities for reasons that escape my smooth brain. Going back to CDOs, by combining the risk from debt instruments, they make it possible to recycle risky debt into AAA-rated bonds that are considered safe. In other words, for you smooth operators out there, hedge funds and banks and other institutions came and put very risky assets all together to make them appear as good. Instead of having, say, one bad-rated bond that was very risky, they came and put it in a basket along with other bad-rated bonds to make it a super bond that would appear on paper as a good investment, even though each underlying bond was very bad. It's like building a column for a house with a ton of cardboard. If you are trying to sell a house that has a column made up of one cardboard, nobody is going to buy it because everyone knows it's going to fail. But if you stick a bunch of cardboards, you might make it appear that it's more stable and get buyers to take it. Since this is unregulated, you get away with pulling this scheme. The house is going to fall eventually, because cardboard cannot hold it forever, but in the meanwhile you get to make bank. This is what happened with CDOs. What took place during 2008 was much like a domino collapse, where one institution falling led to the next one to fall and so on. CDOs were not the only reason why the economy crashed, but they were a big domino in it. Funny enough, CDOs are many times considered to be riskless investments, but that is a trap of itself. They are pretty riskless until the economy flips, in which anyone holding them is going to get absolutely crushed. This was a very basic overview of CDOs and their role in 2008. Let's now bring the concept back to the modern-day struggle of squeezing meme stocks, and why the concept of CDOs did not end back during the Great Recession, but instead was adapted, evolving into something much worse. We all know what ETFs are. They are a basket made up of different securities. They are traded pretty much like stocks. The difference is that exchange-traded funds track an index, sector, commodity or asset. They are a basket of different assets and securities that are well regarded because they are seen as a safer investment due to its diversification. Its undervalue has better legs because it takes into account the whole rather than an individual company. You would think ETFs are just great with little to no risk. Since 2003, ETFs have increased almost 18-fold, increasing in size from merely 120 ETFs to 2,200. Now, it comes to no surprise that the more tied up stocks are to ETFs, the more volatile they become. Upside Chronicles attempted to compare the number of domestic companies listed on the markets. This is because they wanted to try and figure out a potential average number of how many ETFs a stock is in. But something funny happened. The United States, for some odd reason that nobody can explain, stopped reporting how many domestic companies were listed on public markets. I have to agree with Jack Tasman's conclusion that the reason for this is because the number of companies that get listed on the stock market have been decreasing over time. In 2003, there were about 5,200 domestic companies. As of late June of this year, there were under 3,000 domestic companies. So much for a growing economy, right? The numbers are very scary, and the United States is saving face and avoiding questions by simply hiding this important statistic. As you know, pretending a problem doesn't exist is usually the go-to model by which politicians govern. You know what is even more scary? The fact that, ironically enough, the media stopped reporting on this phenomenon taking place. They made articles in the beginning, but now you never hear about it. A simple Google search will show you an article dating back to 2017. It's something that is very hush-hush on the media for reasons that anyone with a wrinkle of common sense can deduce, but I am going to tell you anyways because the number I am about to expose is much scarier than you were even capable of coming up yourself. At one point, around 100 to 200 companies were falling and being delisted from the stock market, but in the year 2018 and 2019, the situation turned dire when America lost around 900 companies. 900 companies in such a small time frame should have chills running down your spine. Even the United States did not inform the World Bank about it because they did not know how to present the information without causing mass panic. So what did the financial world in the American economy do? They had the absolutely abysmal brilliant idea that to solve this problem they simply just have to start creating more ETFs at record speed. They needed to create baskets as a way to make up for the lack of companies in the market. Doing so, they made the exact same play they did in all those years prior to the Great Recession. As Jack Tasman pointed out, modernize things so that ETFs could become the equivalent of what CDOs were. This is already causing massive changes to the economy. There is a reason why private companies are staying private longer and why private equity is exploding in recent years. The growth in SPACs just casually and coincidentally happened to rise just around the exact same time the United States stopped reporting on how many domestic companies were in the stock market. If you have been in meme stocks for a while, you know ETFs are being used to manipulate and suppress GameStop along with AMC and some others. ETFs have also become a tool for hedge funds and friends to better manipulate companies and their outcomes. There is a reason why the media like The Motley Fool and many others are always telling investors to buy into ETFs. It is also why they have turned against the retail investor so harshly. Do you guys think it's a coincidence that news segments are always talking about how it's retail investors who are manipulating the markets? What role did retail have on the squeeze? What role did they have on causing companies to go bankrupt after losing billions of dollars? So far we have cost Wall Street and friends over $6.5 billion this year, and this number will keep on growing. The media, who are bought out by Wall Street because they need to own public opinion so people invest in assets told by so-called experts on TV. The problem is so bad that many of these companies are outright owned by financial institutions. As such, they are driving the narrative day and night about retail traders being the architects of current economic situations so that when the economy crashes, they can conclude their narrative and point fingers at retail traders for causing it to happen, when in reality they were the ones shorting companies out of the stock market and implementing their new CDOs, which are simply ETFs. ETFs are being used to substitute companies so that only a few companies exist, monopolizing the world. The financial media has one job, and that is to curtail attention from this by always talking about ETFs, giving the impression to people no aware of how markets work that there is indeed a ton of options to choose from, when in reality ETFs are just a basket made up of ever-declining numbers of companies that Wall Street keeps devouring through. You will be blamed for the biggest financial collapse in history because they don't want the world to know they engineered the same thing they did in 2008. I have a strong feeling that after the squeeze, a huge battle is going to take place in courts, and retail investors' choice in the free market is going to be challenged. They will say retail investors create market uncertainty, and restrictions should be applied. We might get rich off of GameStop and AMC and some other meme stocks, but if you think the war is going to bring in new divine justice to Wall Street as an immediate aftermath, think again. They will fight tooth and nail so that they can do all of this again in the next sequel, probably 20 to 30 years from now. Stay humble and stay alert. These are very dark times in which we are living. The free world as we know it is being challenged by a small ruling class of psychopaths unwilling to back down. Let me know if you liked the video. I hope I was able to add some wrinkles to those brains of yours. I hope to see you guys tomorrow on the next one. Sorry to put such an extensive video on a Saturday, but I could not wait on talking about this. If you would like to support me, feel free to leave your thoughts on the comments below. If you want to really support the channel long term, I have provided links which will be in the description for donations and a Patreon if you would like to pledge a monthly donation of any kind. This support really goes a long way for me guys. All money is spent on improving equipment and other parts of the channel so that we can continue to upgrade the quality of Simulate and Trade. It is my source of income as I am doing this full time now. It makes a huge impact and difference, so if you are able and willing, do consider it. I will see you guys tomorrow for the next video in preparation for next week. Enjoy the rest of your day and to the moon.